we are all counting down to Friday, 10:05 a.m. Eastern, and Powell's address at the Jackson Hole Symposium. Now, for those of you that remember, late August, the Jackson Hole in August was August 25 through August 27, so roughly a year ago, right? So if we take a look at the, let's see, 25 through 27, here's the 26th, you can see what happened in the aftermath of Jackson Hole. We pretty much peaked at about 4,200, bottomed out around 3,500. So a lot of folks remember what happened through September and into October in the wake of that Jackson Hole Symposium. And the goal of that symposium, the conversation, was what are the economic issues facing the U.S., right? And we're right back to that same conversation as we fast forward to this year's Jackson Hole. And remember, last year, Powell basically had to admit that inflation was indeed not transitory, and then they slowly walked the market into the eventual tightening cycle, which was one of the swiftest in history. We're at the end of that tightening cycle now. Whether we have a pause, whether we have a quarter-point hike, we're at the end. There's probably no reason to expect another major drop because we don't have a major shift to a more hawkish policy. If anything, we're slowly shifting into a pause, which would precede dovish, or policy that would favor lower rates, right? So this is not the same situation as the end of August last year as we go into the end of August this year, and then the subsequent October tightening cycle. We're not there, right? So you might say, Rog, are you bullish? Yeah, gang, I'm just going to put it out there. I'm bullish. I'm absolutely bullish. And there's no reason for me not to be, right? First of all, we have a neutral environment that is oversold. We have price action north of the 200. So I would call this the bullish hemisphere, right? We are still in the bullish hemisphere. As long as we can hold this Darvis support at around 43.50, there's no reason for me to think that potentially the bottom isn't in. We have a lot more to go, and clearly we could see volatility with Thursday and Friday. But if I'm going to say, from a price perspective, an indicator confirmation, I'm going to keep an eye on whether or not we hold at that 43.50 area. That's the S&P. What about the Dow? The Dow is a little bit trickier. The Dow is only now starting to give us that oversold read on the stochastic. And then I want to see that culminate in a minor low or even a test of the daily price movement range, again, in the bullish hemisphere. But the Dow is, again, looking like it might want to put in a bottom. I say might because I'm not here to forecast what's going to happen. I'm looking at what the probability would be. And I'm bullish, gang. Again, the August Jackson Hole is not the same as of 2022. It's not the same as the August of 2023. We've already had that tightening cycle. Right? The worst that Powell could do is say that inflation is not yet where they want. We could see another quarter-point hike. But if you take a look at the Fed Fund futures, we're already expecting a potential hike, right? Look at November. It's not as if this is going to be a shock. While 57% is expecting a pause, 37, almost 38% are expecting a potential quarter-point hike. So this is not going to be a shock to the system. Same thing with December. One of these could be a potential quarter-point hike, but neither of these would be an outright surprise. So this is not the same market. So then the next question is, yeah, Rog, but what about the dollar? What about yields? Let's talk about the dollar. The best way to look at the dollar, gang, is not, nor will it ever be, what's going on in DX futures or the UUP or the DXY. These are all the dollar basket, right? Very different. The dollar basket is 58% euro, and then fairy dusting of the pound sterling, the Japanese yen, the Swedish krona. Exactly, right? The krona? Really? Yes. This is primarily an inverse relationship. The dollar has an inverse relationship to the euro. And let's look back at about a year's worth of euro. What's the euro done this year? Now, remind you, This is as the Federal Reserve was hiking rates, which should generally be a very bullish thing for the dollar. Every time the euro got to the 200, this will be the third time here, during the tightening cycle, this has been a buy for the euro, or on the flip side, it's a short sell of the US dollar. And if I look at where we started the year and where we are now, granted, it's not up that much, but we have put in higher highs throughout the year. And frankly, we are higher than we started the year off. So how could this be really a strong dollar? Hint, it's not. Now, if we're looking at dollar strength since July, for sure. But if I'm looking back throughout 2023 in the tightening cycle, the dollar has continued to weaken. If we can revisit this 200 again, that would be a potential short of the US dollar, long of the euro. I prefer the euro. Again, 58% of the dollar basket is this thing. Okay, so then what about bonds, Rog? What are bonds saying? Bonds are probably continuing to say, we're worried. We're worried about what we don't know. We're worried that the Federal Reserve is going to pause too soon. We're worried that the Federal Reserve is still not tackling inflation. The bond market is a unique market. They like to play a game of chicken with the Federal Reserve, right? They like to front run the Federal Reserve, and that's okay. It really is. What we have to remember is until the bond market stops dropping, yields are going to continue to move higher. But let me remind y'all of something. Take a look at 1 year of bond action. Someone could look at the bond market and say, oh my gosh, these higher yields, equities have no choice but to move lower on this. And that would be a ridiculous thing to say. Let me show you why. All right, let's use the action from this peak in April. That's the highest high we saw so far this year. Okay, so let's go back to April, because we could say the bond market has clearly been moving lower since April. What have equities been doing since April, gang? Let's start with the S&P. They've been moving higher. Okay, well, that's just one index, Rog. What about the NASDAQ? In that same window where yields were higher and bonds were moving lower. Oh, gosh, NASDAQ's higher too. All right, well, surely the Russell isn't buying into that. For the most part, it has. So please don't buy into the false idea that higher yields kill the equity markets. All year long, and since the peak in bonds, they absolutely have not. So remember, our job is not to pick a target and talk about some nightmare scenario about equities. Our job is not to pick targets, but figure out the path to controlling risk and follow through, right? And as long as we focus on that, we're not going to fall into narratives about, oh, equities must fall because yields are falling. Again, we're in a choppy environment with a lot of uncertainty going into Jackson Hole. A lot of folks remember what happened last year. I'm here to tell you this is very different than last year. So this is how I'm looking at it. This is how I'm positioning our traders, because at the end of the day, gang, analysis, who cares what I think and feel, right? It only matters what I'm doing. And we are looking for long positions. We are shortening the time frame until Friday, 10:05 a.m. Eastern. We're going to day trade, short-term swing trade. But as we get closer and closer to this event, I'm going to do the same thing I did with my traders last week. We swing bought, got long calls in things like oil stocks and healthcare stocks. And I'm going to look for a similar setup again. So analysis, sure. What are we going to do? I'm looking for a buying opportunity, gang. I'll see you in the next update. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.